and welcome to the fifth session of Path to Professional Trading. So today we chose to talk about the candlestick patterns. Candlestick charting is among one of the main components of technical analysis. A lot of traders do rely on candlestick charts in order to assess the market movements. So first, let's start with the basics, how they were found. So it was from a Japanese rice merchant. His name was Homa Monehisa. It goes back to 1700s. He discovered that the market is always influenced or is being influenced by the emotions of traders, which is the thing that we always talk about, that emotions of a trader do force them sometimes to take certain actions in the market, leading to certain patterns. So in order for him to understand more how the market is being influenced by these emotions, he decided to point or to draw a certain chart that would give him certain price components. They are the four price components of a certain time frame. So for example, if we take the time frame within a day, so the candlestick will show us the four price components of the day: the opening price of the day, the highest price reached through the day, the lowest price also reached through the day, and the final price or the closing price. So traders do use the candlesticks in order to forecast the future price movements. We can have certain assumptions on the formations of candlesticks. We have the candlestick patterns, which could hint for a certain or suggest a reversal or continuation of a certain trend. And these patterns, they could consist of either one candle alone. One candle alone can give us a certain assumption on the market or a certain consensus for the market, and also a couple of candles together, they can form a certain pattern, which would also help us to decide or to detect maybe where the market could be going. So this is the candlestick. It's very easy, straightforward. We have the four price components. They are here. So for example, I'm just gonna draw on the chart on the PowerPoint in order for you to understand what's how the candle is plotted. So first, let's say during the day. So at today's open, for example, let's take gold into consideration. We're trading gold. So the opening price was 1950. The market rose to 1970, and then it fell back to 1900, and it closed at 1920. So this is the price performance of a certain day. We have the open price here, open. We have the highest price, we have the lowest price, and we have the closing price. So this is how a negative candle shows. So for example, if the candle is in red or usually a dark color, it means that the market closed at a lower price than the opening price. Similar to here, you can see this is the open. The market went higher, and then after that it reversed and went lower to post a certain low, and then recovered slightly to have the close here. So this is the difference between the open and the high, and the close and the low. These are called tails or shadows or wicks. They are they could be used also for certain hints about a certain price action. And this candle here, it shows the fill. So for example, if we just hover on the MetaTrader 4 platform, if you hover with the mouse over the candle, you will be able to see the four price components: the opening price, highest price, lowest price, and the closing price. So, and if we're just looking for a bullish candle, we're gonna demonstrate. So this is the opening price for gold. For example, it opened at 1900 and then fell to 1890 and then rose to almost 1940 and closed the day or ended the day at 1930. So this is the opening price. This is the lowest price, highest price, and the closing price. So this is how the day would be, how the chart, the line chart would be, and this is how it would be looking at, it would be appearing as a candlestick. It would be a positive bullish candle, light color. Usually traders use blue or green color to indicate that, or to show that the market is going up or there's a bullish movement in the market. Here you can see this is the opening price. This is the tail between the open and the low. The market went up to a certain high and then retreated or surrendered part of the gains and then closed here. So also this is a tail or a wick or a shadow that would also tell us certain indications about the price. And this is all about the candlestick itself. So to recap, the candle shows us 4 price components: open, high, low, close. Usually bullish candles are shown in lighter colors. They tend to reveal that the market closed at a higher price than the opening price, while a bearish candle is usually dark in color. It's almost red. Most of the time they use the red color, and it tends that the market closed at a lower price than the opening price. So this is how a candlestick works. So let's move now to candlestick patterns. I'm going to talk about 2 candlestick patterns. One of them is basic. It consists of 2 candles. Another one consists of 3, and then my colleague Sai will be demonstrating or speaking about single candles. So first, with the bullish and bearish engulfing patterns, they are among the most reliable and most used or most detected candlestick patterns. They consist of 2 candles where the second candle shows a complete reversal of the first candle. Meaning, for example, today the market was trading lower, 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 and then the second day the market was able to reverse. There is something that happened in the market, and then the price was able to reverse all these losses. The market went up, 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 and then closed here. So this is the opening price of yesterday. This is the closing price of yesterday. The closing price of yesterday is today's opening price, and then the market closed here. So it means that the market fell and then was able to recover all the losses in the consecutive or the coming candle. So this means that all the negativity that was there during the first segment, it was removed or demolished during the second segment. This is a bullish engulfing pattern. It suggests that the buyers are getting in control after it moved down. So the market moved down, and then buyers were buying, and then they were able to push sellers up, and then the market rose. So for example, here for gold, it was trading at 1900, and then it fell towards maybe let's say 1880, and then the market was able to recover the second day and rise towards 1920. So all the losses, the $20 losses, were removed, and then the market was able to recover and also post some gains. This is the bullish engulfing pattern. The bearish engulfing pattern is the other way around. The market was moving up, but couldn't hold these gains, and then the second candle, all these gains were lost or surrendered, and the market fell to new lows. This is the opening price. This is the closing price of the first candle. This is the opening of the second candle. This is the close of the second candle. So all the bullishness that we took during the first candle was removed by the second candle, and this could hint that the market is continuing down. So this is the bullish engulfing pattern, and this is the bearish engulfing pattern. I'm just gonna try to demonstrate. So here's the market. It was trading here, and then we had the certain high. The market went to a certain low and then closed here. The second day it opened here. The market went down and then went up, and then was closing here. So all the negativity that we took the first day or the first candle was removed the second day, or was recovered the second day. This could hint that the market is going to continue to the upper side in the coming candles. The other way around for the second one, the market opened here. We went for a certain low, then the market went up to a high and then closed here. The second day the market opened. We had a certain high, the market went to a certain low, and then we closed here. So all the positivity earned during the first candle was lost during the second candle, and we have a more bearish bias, hinting that the market could continue to the downside in the coming candle. So this is all about the bullish engulfing and bearish engulfing patterns. There are very known patterns. There are we see them more often in the market. I'm just going to demonstrate while finishing the morning and evening star. I'm just going to demonstrate the MetaTrader 4 before moving towards other type of candlesticks. So now let's start. Let's continue with the evening star and morning star patterns. This is morning star and not a T. So evening star and morning star patterns are also popular reversal patterns taking place at the top or the bottom of a trend. They consist of 3 candles. Evening star patterns appears at the top of an uptrend and signals that is about to end, and the contrary for the morning star. So for example, let's demonstrate here. The market was moving up, so this is the market went down, market went up to a certain high, it came here, the market opened, certain low, high, and then the market came here, another high, and the market dropped to a low and then dropped here. So this is a reversal, the reversal pattern or reversal formation, meaning that the market was rising and then the gains, the market couldn't, or the certain instrument that we're trading wasn't able to hold these gains that were posted, and the market went down in this candle, and this could hint that the market's going to continue down in the coming candles with a negative trend. So this is a bearish formation, the evening star, meaning that the market after this formation it tends to move lower. The vice versa, or the contrary, for the morning star, we were trading inside a certain movement, the market went down, went up, and then this down, and then the market recovered. So all the negativity that we had these 2 days, or these 2 candles, were removed by the positivity of this candle, and this could suggest it's going to continue to the upside. So now I'm going to move to MetaTrader 4 platform just to demonstrate how you can detect these patterns. So let's, for example, go to this is the H4 chart. I'm going to just choose, for example, gold. This is gold and the H4. Let's look for a certain reversal. So for example, this is a bearish engulfing candle here, and the market was moving down. So this is a bearish engulfing candle. So here you can see all the positivity earned here in this candle were removed during the second candle, hinting that the market is going down. So as a trader, what you can do is just you can initiate a sell position here with a stop loss here or even higher, and then you aim for 1-to-1, or just you can trade your stop loss and aim for a lower. So this is the market, it went down, and it was a successful trade. So there definitely you can't just state that these patterns they always work. We have a lot of defects in such patterns, but definitely you have to trade the proper ones. Maybe you can add some filters. For example, this one here, you can see the bearish engulfing pattern. We had a certain positivity, the market was moving up, and then we had this pattern, the market was able to erase wasn't able to sustain the gains, and then we had this move lower. So you can, as a trader, you can just initiate a trade here, selling a trade. You can set your stop loss here or at the previous stop. Maybe you can just look for previous stops and set a stop loss, and the market went down, so you can trade your stop losses. Even here, for example, you can see we had the bearish candle, bullish candle that reversed all these losses. So a trader would have a buy position here with the stop loss here, and you can see that the market moved higher. Also here we had another bullish candle, a bullish formation, so all the negativity here was reversed the second day, and the market continued higher. So this is how you can trade these patterns. It's very easy to trade candlestick patterns. Now I'm gonna leave the mic to my colleague Sai. He's gonna be talking about single candlesticks and how you can benefit from these formations.
Thanks, Wael. Hello to everyone. Hope everyone's doing good. Next, we are going to look into the next type of patterns today. And what we are going to look today, and we are discussing, is all the important patterns we've seen in the candlesticks. So the next is a Doji candle. If you say a Doji candle, let me show you how exactly the Doji candle looks like. It simply looks like a cross sign, a type of a sign symbol. So here you can say like a Doji. A Doji candle is one of the most unique candlesticks formation that shows that the open and close price of a certain instrument are almost exactly the same. And previously, while we were showing about there is a body formation happen in the candlesticks, that means the bullish or bearish. You can see there is certain number of parameters of move happen in the closing and opening. But when coming to the Doji, it's a neutral patterns. That means it's open in the same price and closes the same price. So Doji candle looks like exactly a cross, an inverted cross, or like a plus sign. So they are neutral patterns. They usually take the place in a significant continuous of the patterns. It's very simple to identify and easy to identify, and a very effective way of patterns is this. Usually occurs in different parameters. Usually have very effective on higher level of parameters, like we take for 30 minutes, 1 hour, 4 hours, even daily, weekly, and monthly are more effective on a long run rate. So we can see the dojis, we can see the three way of things. We can see a cross symbol here. That means the market opens at this price. For example, the market moves up or maybe down, and again market came back and closed the same price. So this is another way of doji. And talking about the second one, which is a formation as a lower tail, we can see the weakest form on the lower side. the spike is happening lower. That means the market opened at this level and made some high, a little bit high, and market came back drastically to the down, and again couldn't be able to sustain the same level and bounce back to the same level where the market has been opened. It closed the same level. So it looks like a type of across, so which is a lower spike one. If you're talking about the third type of doji, the market closed in this level and given some low levels, and market went high to the maximum and came back and closed the same level where the market is open. So these are the different type of doji usually forms in the market's directions. So for example, we take for this type of doji, when the market trend was on the downside and this formation has happened, definitely the market is going to be trend on the reversal side. That's very simple. Downside and this formation is there, and you can take a market on the upside direction. Simple way, the direction is going up, you can keep a stop loss in the below this low, and you can keep trailing your stop loss when the market keeps on the upside directions. We're talking about this doji, which is a spike on upside, where is an uptrend happen, and this formation has been clear signal when there's going to be a downside trend. So keeping on this direction after this confirmation, you can be on a sell side trade, and keeping a stop loss, you keep moving on this. So this is one of the effective type of patterns. Let's move on the next one, which is Marbuzo candle. Is a full body candle. Let me show the candle how exactly it looks. Where we've seen some spikes and wick over there in the previous candlestick patterns. Here we can't see anything much. It's just a flat. That means it opens and closes very flat, which gives a high and the low as the same level. So when talking about description about this patterns, you can see the Marbuzo candle is a full body candlesticks with the minimal wick. That means a very low wick maybe happens sometimes, or maybe not given the spike for the range in the large size of the and signals strong momentum. A signal that strictly buyers and sellers control the momentum with a specified period. This Marbuzo usually suggests to continue the proceeding to the move. So for example, if you go to the slide, you can see there is this formation happens. For example, a market has a downtrend, continuously there was a downtrend. And you can see this type of bullish patterns, and this going to continue further. It's mean that there's a heavy number of volume on the buyer side. That means the market has a huge volume, which is going to create further on the upside direction. When this bearish formation happens, and it's going to continue on the further downside because it's a very close, and it closes on the lower level of the market close. So basically, these patterns have a heavy volume of trading that it's going to continue on a one side direction and keep moving on the trend side. So let's move on to the next one. It's very easy to understand and very simple, and usually it's a very important and effective patterns usually occurs in the candlesticks type of traders. There are many traders usually for example, take for technical traders, like they are they do trade with indicators and oscillators and different type of tools, but there are traders who really depend on keen on only on the patterns, because they're very effective one. It's more reliable on the type of indications. So when I'm talking about the next one is that we are going to talk about the hammer and hanging man. Let me show you the how it exactly the candles pattern looks like. This is how exactly the hammer looks, and this is how the hanging man is going to be on this. So let me describe about what exactly the hammer and hanging man. Hammer and hanging man patterns tend to suggest a reversal of a certain trend. So that means it's going to reverse. For example, the market is a bullish trend, and this formation happens, it's going to be a downtrend, and with the downtrend and this formation happens, it's going to be a bullish trend. Exactly, it's going to be a reversal type of trend. So they may have small bodies, a small upper wick, and a long lower wick. The hammer indicates a possible reverse of bearish trend. That means when there is a bearish trend is there, the hammer formation is going to be a bullish trend. And hanging man represents the potential reverse of uptrend. That means when there is a bearish trend is there, and this formation of patterns occur, then it's going to be a uptrend. So let's go on to this. So for a clear notification, we can see a clear picture how exactly the candlestick forms when this type of patterns forms. So when there's a bearish trend continues to happen, and the hammer patterns continues to be indications being seen, so this is going to be continue on the upside direction. That's why I said there is a reversal of any downtrend. And when talking about the hanging man, when there is a bullish trend in the market and this hanging man type of patterns occurs, is going to be a bearish trend. So for example, when this happens, suddenly you know be knowing, notifying that how exactly the pattern is going to be. Not to be jump on the market when before this close, because the closing is very important for each and every patterns to indicate or to confirm what type of patterns exactly it is. So when this formations happen, then after later, the next candle, maybe it's hourly, maybe where 1 hour candle to be closed, or maybe 4 hours or daily, whatever, the candle to be completely closed. After that, you're going to take your call on the upside direction. And in case of hanging man, when this formation happens, so next candle onwards, you're going to be on the downside trend. It's a very effective one. Definitely you can have a look on an history of the charts. You get a lot of knowledge about this. Let's move on. The next one is exactly opposite to this. It's inverted hammer and shooting star. This is nothing but the opposite of hanging man and hammer. So inverted hammer and the shooting star, let me show you how exactly it looks. Have you seen this previous one? You can see this. Exactly the opposite of hammer and hanging man. So here the name it as inverted hammer and shooting star. Here, the inverted hammer and shooting star patterns are exactly the opposite of the hammer and the hanging man, but they are also a reversal pattern. As I said, reversal pattern is nothing but whereas a bullish trend is there, and this formation will go to a formation patterns comes. So it's going to be a downside trend, and there is a downside. Obviously, the pattern is going to be on a reversal on the bullish trend. They all have small bodies, a smaller lower wick, and a longer upper wick. The inverted hammer refers the reversal of the bearish trend, and the shooting stars signals are possible to end the bullish rally. Let me give you a small brief how exactly it's going to be on a chart. So when there is a bearish trend continually trading on the downside, and when this inverted hammer, exactly reverse of the hammer, which is the inverted hammer, and there's going to continue on the upside directions. When you're coming to the shooting star, when the market has a bullish trend, and is clearly give an indication of a shooting star, and this is going to be continue on the downside trend. It's very simple to identify, easy to identify. We have taken only a few important patterns there, which are very clearly indicate on your charts on a MetaTrader 4, which really indicate to identify what type of trade, and is easily to identify, and you can keep a more reliable, which you keep practicing on your this type of patterns. Hope you understand, and this for today. If you have any doubts, please write your questions. Thank you.
Okay, perfect. Thank you, Sai. If anyone has any question, please write it down. I would just like to remind you that all the information, news, analysis, and opinions mentioned in this webinar only serve for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument, and ICM doesn't provide any investment advice. Okay, so there's a question, does it matter if the engulfing candles are the same color? I didn't get you. You can choose the color for the candles. Usually if you have to set your chart on your chart properties, you set the color of negative candles and positive candles, or bearish candles and bullish candles. So definitely they can be of the same color, since we're talking about a move down, another move, the opposite move up. So it's just an engulfing candle. It's erasing all the previous move. So definitely they can be of the same color. So maybe if I just misinterpreted the question, if you can write it in other words.
There is a question like, should we analyze the candle by candle during the trading? Yes, basically it's all depend on which time frame you follow the candlesticks. For example, if you follow a 1 hour candle, definitely you have to follow each and every hour of the closing to be followed, because each hour closing is very important for each and every candlesticks patterns. For example, you start doing for the 4 hours, please keep watching 1 hour, 2 hour, 3 hour, 4 hour, maybe 5th hour, it may give you some patterns for you. So based on the closing of each and every candle on a different time frame, it's most important to monitor and to be identify which type of patterns to be formed. There is one more question. The Doji candle that is like a cross, does it signal continuations? Yes, obviously. Like if there is any formation on the Doji, like in a cross type of signal is there, and there should be a continuation formation, or be there, the market can give the continuation on the signals. Even as I shown you some second and third of Doji today, which is a spike, weak on the lower, higher, weak on the lower side, which is a signal in the market as a downtrend, and this formation which leads to the upside trend. When there is a spike or weak on the higher level, higher side, which is the highest, most weak on the upper side. So when there is a bullish trend, this formation will leads to the downside trend. There's the question, does Morbuzo give signal at any part of the chart? Basically, it's type of patterns, as I said, like it's a simple way of understanding. So give the moment of the directions, which is in a range of move. So normally it's in a clear word, we can see a lot of indication to identify for the momentum base, basically.
So just to recap, we have a certain different patterns. So these patterns, they consist of 1, 2, 3 candles or even more. The clear reversal patterns, they are, for example, the bullish and bearish engulfing candles or a candlestick pattern. Also the evening and morning star, the ones that I talked about first, they are clear reversal patterns. And also, as I mentioned, there are some of these hammers, inverted hammer, hanging man. Also, these single patterns, they are, or single candles, they hint sometimes for a certain reversal. So all you have to do is just, you can match what's happening in the market, or the price action that's happening in the market, with the catalysts that are available in the markets, or the movers that are available in the markets. And this would help you easier to detect which are giving you a proper reversal signal, so you can even filter, despite the fact that, like for example, there are certain studies, for example, for the bullish and bearish engulfing patterns, that they are reversal patterns, but also you can filter for sometimes. For example, if we I'm just going to demonstrate on the chart so it's easier for everyone. Sometimes even if we have a move up for a bullish candle, then we have a move down, which is a bearish engulfing candle. If the market is in uncertainty and we don't have like a certain factors that could drive the market in a certain way, we can go over the third candle or the second candle. Here we're going to have 2 candles, for example, or 3 candles within the opposite direction. So this bearish engulfing pattern here is not valid. So that's why, for example, similar to this one, if you can see here, the market reversed, but this candle was very, very big to the downside, thinking that the market was falling sharp, and this triggered some correction, and the market moved higher. So sometimes it's not always that the market is moving typically on these patterns. What is recommended to do is just to make sure that you add some filters to these patterns and try to pick up them, which could be the best patterns. What I'm talking about, for example, this bearish movement here, like it's a bearish engulfing for the previous 2 days. So we have a bearish engulfing candle. Here we have the bullish engulfing candle. Until the market here had another bearish engulfing candle. We had a move here, so you can see 1 candle up, 1 candle down. This is due to uncertainty, and it wasn't very reliable to use candlestick patterns. In general, the key patterns that they are usually used in the market in candlesticks as reversal pattern. For example, this is a bullish engulfing pattern. This is almost a bearish engulfing candle, but this is not accurate. This one is similar to this one. You can see here how the market here was bearish, and then we had a correction, and here also we had bullishness, and then the market triggered some correction. This is a perfect reversal pattern, perfect bearish engulfing pattern. This is almost also had some positivity, so almost we recovered all these losses incurred throughout the day. So here in front of us at this chart, you can just pick a couple of patterns that they were successful. We can't say that these patterns, they are 100% accurate, but there is certain probability for these to act or to hint properly within the coming move. But this would definitely also depend on the factor that could help the instrument to move in a certain direction. Perfect. I believe this is it for today. Thank you all for attending. So I would like to add anything.
All good. Thank you.
Okay, perfect. Wish you all successful trading throughout the week, and hopefully we'll have another one on next Wednesday. Thank you all for joining.